In the early 2000s, one of the most feared forces on Wall Street wasn't a hedge fund or a billionaire banker, but Japanese housewives. Thousands of ordinary women quietly built a financial movement so powerful, it shook global currency markets and baffled even the pros. They weren't supposed to win, but they did. This is the story of the Mrs. Watanabes. First, some context. In the 1990s, Japan's economy had a major setback. The real estate industry and stock market burst around 1990, and Japan entered a lost decade of low growth. Land, property, and stock prices fell drastically. For many years, consumer prices barely rose. The central bank cut interest rates to almost zero to try to fight deflation. Banks paid almost nothing on savings accounts. In fact, Japan was said to be shackled by zero rates for years. Money parked in a bank earned almost 0%. Then entered Mrs. Watanabe. In the late 1990s and early 2000s, financial analysts noticed something surprising. Small investors in Japan were having a big impact on global currencies. British magazine The Economist coined a nickname for these Japanese investors. They were called Mrs. Watanabe. Watanabe is a common Japanese surname, and since many of these early traders were married women, they added the prefix Mrs. It was often the housewife who managed the household budget and savings, but with interest rates so low, ordinary savings accounts gave almost no return. Smart families needed a new way to earn a little more. Meanwhile, in the late 1990s and early 2000s, the internet and online trading were becoming available. This made it easy for private people to buy and sell currencies from their computers. Suddenly, a new opportunity opened up at the kitchen table. These housewives turned their free time into trading time. They would log on after the kids were in bed and check exchange rates. If they thought the US dollar or Australian dollar would stay higher than the yen, they would swap yen for those currencies. In short, they were betting on the dollar and other currencies rising against the yen. Wall Street and big banks started paying attention. Why? Because thousands of these small trades taken together started to move markets. Many ordinary Japanese people, including housewives, were even using borrowed money to trade currencies. This was driven by one simple fact. Japan's near-zero bank rates made savings useless. In Japan's economy of those years, a typical household was sitting on a huge pile of cash. One analysis put Japanese household assets at around 1.8 quadrillion yen, over $17 trillion. More than half of that was just in bank deposits or cash, and it was earning almost nothing. Many saw that they could do better by investing. By about 2007, the collective power of Mrs. Watanabe had become staggering. Estimates say Japanese retail traders were trading on the order of $9 to $10 billion worth of currencies every day. Their daily trading was big enough to be a major share of Tokyo's market, and they truly shook global finance. Bank officials were impressed. Bank of Japan director Kiyohiko Nishimura famously said that the old gnomes of Zurich, an old nickname for currency speculators, had been replaced by Tokyo housewives. He warned that if these retail traders changed strategies suddenly, it could dramatically shift currency markets. This was no joke. Even one casual trader account turning losses into sales could make the dollar-yen rate jump or drop. What exactly was Mrs. Watanabe's secret weapon? It was a simple strategy called the currency carry trade. This took advantage of Japan's very low interest rates versus higher rates in other countries. Here's how it worked in plain terms. The housewives borrow cheap yen by taking a loan in Japanese yen, where interest might be near 0%. They then exchange that yen into a currency like US dollars, Australian dollars, or others that pay higher interest. Next, they use the borrowed money, now in dollars or another currency, to buy bonds or deposit it in that country so they earn higher interest. If all goes well, they get paid the higher interest on the foreign currency, and you only owe the low interest on the yen loan. The profit is roughly the difference. Eventually, they convert the foreign currency back to yen, repay the yen loan, and keep the extra money earned. If the exchange rate between yen and the foreign currency didn't move too much, the trader would earn that interest difference as profit. For example, imagine Mrs. Watanabe borrowed 1 million yen at 0.5% interest. She swapped it into about 8,000 US dollars and invested those dollars at 5% interest. After a year, she would pay roughly $5,000 in yen interest, but earn about $400 in dollar interest. which might be around 40,000 yen. If the dollar stayed at the same exchange rate, she would net a gain of roughly 35,000 yen. That kind of margin was essentially free money, as long as the currency exchange stayed favorable. Early on, this strategy worked brilliantly because US and Australian rates were much higher than Japan's near-zero rate. While the concept was easy to explain, successful trading still took skill. Mrs. Watanabe traders learned to watch interest rate news, economic reports, and even charts of price movements. They tended to be conservative. Many preferred doing a few well-planned trades instead of risky bets. They set up stop-loss orders to cut losses if things moved against them. Over time, many became disciplined. They carefully looked for the best interest rates around the world and knew how to swap money from one to another to earn that extra yield. As more housewives caught on, Mrs. Watanabe's influence spread. Currency brokers started hiring more staff to serve retail clients. TV commercials and internet ads in Japan showed how easy it could be. Special investment magazines appeared for them. In Tokyo, coffee shops and online forums, women exchanged tips on markets and trading tools. By the mid-2000s, Mrs. Watanabe had become legendary. Thousands of people were doing carry trades every day. Even major central banks took notice. The Reserve Bank of Australia studied these Japanese traders because they often bought Australian dollars. International banks said these retail investors were among the most influential retail groups in currency markets. By 2007, Japanese retail investors were trading $9.1 billion worth of forex daily, nearly one-fifth of Tokyo's trades. With such volume, Tokyo's yen dealers had to watch them. It was a complete role reversal. Instead of big banks leading, these housewives were the ones taking the lead. When most expected the dollar to fall, Mrs. Watanabe often bought it, and vice versa. Bankers joked that if Mrs. Watanabe ever suddenly changed her mind, they'd better duck for cover. Of course, no strategy is foolproof. The carry trade had a big catch. If the yen rose instead of falling or staying weak, the plan would blow up. And there were times it blew up hard. The fierce shock came during the 1998 Russian crisis. In August 1998, Russia defaulted on its debt. This sent a shockwave through global finance. Investors panicked and ran to safe assets. One of the safest at that time was the Japanese yen. What happened? The yen's value jumped sharply against other currencies. Suddenly, every carry trader who had bet on a weak yen was losing money. Profits turned to losses almost overnight. Mrs. Watanabe felt it too. Many smaller traders saw much of their gains wiped out. It was a wake-up call that their free money scheme could vanish in a crisis. Despite the losses, the Mrs. Watanabe phenomenon did not die. Today's Mrs. Watanabe still exist, though their tactics may have evolved. Some now use derivatives or digital tools. Others watch cryptocurrencies. In a way, Mrs. Watanabe is a modern David versus Goliath story. With no fancy office or high salary, these traders use discipline, community, and simple math to make profits. The era of Mrs. Watanabe taught us to pay attention. In the age of internet trading, even a kitchen table can hold the gears of Wall Street.